All right, so let's begin. So today's topic is various types of investments. Okay, we are going to discuss about what are the different kinds of investment that you can consider to secure your future financially. Okay, again, I'm your presenter. My name is Sayed Moyuddin, and most people know me as Miles, or they call me Miles. Okay, so this is a disclaimer about today's webinar. This presentation is only for education purposes. This is not a step-by-step guide. This is not any advice of any particular investment company or investment agency. This is just for education purposes so that you guys can gain knowledge and make an informed decision about your investments. Okay. So these are today's agendas that we are going to discuss about. What are the different tax saving schemes are there in the market, mutual funds, SIP, and what are the things that you should know before investing in mutual funds. Now, keep in mind, this applies to both categories of people. Either you're a salaried employee where you're working on salary, or you're a businessman or businesswoman. You have your income through your own business. These things can apply to both type of categories, and this will help you make an informed decision about your future investments. Now, let's begin about with introduction. Again, as I mentioned, my name is Sayed Moyuddin. I have been a recruiting expert for last 10 years. I have recruited for multiple different countries that includes India, US, UK, Australia, Canada, and a lot of different South American countries as well. I started,
Africa also.
sorry?
South Africa also.
Unfortunately, I did not get a chance to work in South Africa yet, but I did work
Yes.
in different countries like India, US, UK, Australia, South America. Okay. So I started my career as a junior recruiter 10 years ago, exactly 10 years ago. And by the grace of God and luckily through hard work, I was able to climb the corporate ladder. And currently, I'm working as an head of operations and head of HR management in one of the companies. Okay. Now, let's begin with our first agenda. That is types of investment where you can save your income taxes. So whether you are a salaried employee or whether you are a businessman or businesswoman, how can you save your income? How can you save your income taxes? Okay, so obviously, if you're working, maybe it's your own business or you're working as an employee, you will have to pay your income tax based on your tax bracket, based on the net income that you're earning per year. And every year, generally, do our tax filing in April, on 1st of April. So whether you're salaried, whether you're a business personnel, you will have to pay for your income tax. Now, these are the different methods where you can use to save your income tax. There are various different deductions that happens throughout the tax brackets, and you can use different features, different options, different things to save your income tax. So first, for salaried employees, you can definitely utilize section 80C. 80C is a section within your income tax filing form where you can save up to 1.5 lakh rupees annually in income tax. Okay. Now, to qualify for Section 80C, you will have to invest in these different areas. First of all, tax saving investments. You can make different tax saving investments to save your income tax. Second, if you're still pursuing your education while working, you can use your education loan to waive off your income tax as well in Section 80C up to 1.5 lakh rupees. You can make long-term capital gain investments. Okay, long-term capital gain investments are anything which are invested with a lock-in period of 5 years. So if you are able to invest in any mutual funds or any stock exchange for a lock-in period of 5 years, you can use that amount or you can use those gains as an exemption from income tax. Next thing is you can make charitable donations. You can donate to different organizations. You can donate to different schools or organizations or anything. And as long as you have a valid receipt, you will be able to claim those donations as tax exemptions. Meaning you can, whatever amount that you donate, you will be able to save that in your income tax as well. Deductions on expenses. If this is majorly for business personnel, a lot of time when you have your own business, you will be making a lot of different expenses, maybe in terms of infrastructure. Maybe you're renting a place, renting an office, renting a manufacturing company, whatever kind of business it might be. If you're renting, you can definitely deduct that as an expense. Whatever equipment that you purchase within that year, whatever things that you buy that is directly related to your company or your business, you can write that off as an expense and you can save your income tax over there as well. So any kind of expense that you make in relations to your business, you can save that money as a as an expense deduction. Okay, if you're traveling related to your business, that comes under deduct expenses for business. If you're purchasing something for your business, that comes under expenses. If you are providing some sort of services which cost a lot of money, you can use that as a deduction as well. So next is home loan. If you are able to purchase a property on home loan, you can use both those, the principal amount as well as the interest that you pay on that amount, as your tax exemption. So you can save your income tax on home loans as well. Next is house rental allowance. So if you did not purchase your own house, you don't have your own house, instead you're renting out, you can use that amount of rent, which is HRA, for tax exemptions as well. Next is leave travel allowances. So whether you're a salaried employee or you're a business personnel, you can use your travel expenses as leave travel allowances and exempt them from your income tax. But keep in mind, you can do this only twice every 2 years, meaning you cannot travel more than 2 times under this category. If you if you traveled anywhere across India in related to your business or in related to your personal thing, you can get that exempt from your income tax as well. Now, income tax savings. So there are multiple different kinds of income tax savings that you can make. One of the things is equity linked saving schemes, ELSS. You can invest in various different equities for a period of 5 years or longer, and you can save that money in your income tax. You can deduct that money from your income tax. Next is ULIP, also known as United Linked Insurance Plans. You can virtually purchase this insurance plans for both for your life insurance as well as in purpose of your investment as well. ULIP usually invest in various different stocks and mutual funds, and at the same time, they will provide you a wholesome insurance plan as well, which covers various different things like accidents, injury, deaths, everything. So you can get paid for those, as well as it can be used as an investment tool as well. You can invest in this policy for 10 years, 15 years, 20 years, and at the end of that policy terms, once you successfully made your entire payments, you will get a whole lump sum amount back, and not just the amount that you have paid, but also any profits that you have gained from those investments. ULIP is one of the most preferred investment scheme for different personnels. Again, both for salaried as well as for business personnels. Next is Public Provident Fund, PPF. If you're a salaried person, PPF is always a better option. The gains are very low. You might only gain up to 2 to 3% per year, or if you're lucky, maybe 5 to 6% a year. It depends from year to year. It changes, it varies from year to year based on the government that's in power right now. So, and based on the decisions the government takes. So PPF is always a preferred option for salaried employees. Again, all the investments or all the payments that you make on PPF are also tax exempt. Next is Employee Provident Fund. Again, this is from your employer. Same thing as PPF, but this time it's from your employer. You can make EPF payment and you can use those investments or payments as tax exemption. Next is your traditional insurance plans. You can purchase medical insurance, health insurance, life insurance, etc. All those insurances that you purchase are also tax exempt as well. Next is National Savings Certificate. Again, this is considered one of the safest investment, but at the same time, this also gives you the lowest amount of returns. So you can invest in National Savings Certificate scheme for next 30 years. Your money would be safe, and there's almost a 99% guarantee that you will get all your investment back, but the returns are very low, meaning the profits are really low. The profit might just be anywhere around 6%. Next is Sukanya Samriddhi Yojana. You can use this government scheme as well. If you have a daughter, you can invest in Sukanya Samriddhi Yojana and save your income for get your investment exempted from your income tax. Next again is National Pension Scheme, another government scheme. This also is considered as one of the safest investment plan. Again, the returns will be very low. You can invest in this scheme for next 30 years and there's almost a guarantee that you will get all of your money back, but the profit might just be anywhere between 4 to 6%, meaning let's say in next 30 years you were able to invest let's say 1 crore rupees. Your investment profit return, you will get your 1 crore back. At the same time, the profit return would just be 4 to 6%. So let's say if you got 6% profit, that means you only gain 6 lakh rupees back. Now, next is senior citizen saving schemes. Again, if you're a senior citizen, you can apply for this government scheme and you can save a lot of income tax as well. And lastly, again, one of the most preferred method, but at the same time, something that gives you very low returns as well, fixed deposit. You can make a fixed deposit for next 10 years, but the returns will be very low, maybe around 6.5% or 7%, depending on the bank or the investment agency that you choose to work with. Again, you can invest 1 crore in 10 years for fixed deposit. The returns might only be 6.5%, meaning per year gain might only be up to 6.5 lakh rupees. Now, second type, as we discussed earlier, education loans. Okay, any interest that you pay on your education loan will be exempt from your income tax. So again, as I mentioned, if you're a salaried person or if you're studying while working, whether it might be on a job or maybe with your business, you can, if you took an education loan, you can get that tax exempt from your income. Next is long-term capital gain exemptions. Okay, any mutual fund or any equity scheme where you invest for more than 3 years or 5 years, all the gains, all the profit that you earn with those investments are tax exempt again. Now keep in mind that amount should not exceed for more than 1 lakh per financial year. Financial year means April to April. So you should not invest more than 1 lakh rupees from April to next April within this 1 year to qualify for this exemption. Again, charitable donation. You can make charitable donation to different organizations, NGOs, political party, or Swachh Bharat Yojana, or Clean Ganga funds, or any national fund and you can get exemption for all your donations, and usually you will get at least 50% and most of the time up to 100% of your donations. You can save that income tax in section 80G. Okay, now keep in mind, wherever you donate your amount, they should provide with you a proper receipt. That receipt should include the address, the registration number, and PAN number if the amount exceed more than 2000 rupees. Next is deduction on expenses. So now again, as I said, this is mostly preferred by business personnel, but this also applies for salaried personnel as well. If you're paying education tuition fee, you can save your income tax and write it off as expenses. For any medical expenses that occur throughout the year, you can use which as well as for handicapped personnel as well. For any medical expenses that occurs throughout the year, you can use them as tax exempt. And you know, at the same time, any expense any expense that you made or your employer made for sorry you have made, you can submit them to your employer for tax exemption as well. But keep in mind, things like phone bill or something else will not qualify for tax exemption. Next is home loan. Again, as I said, both your principal amount and your interest, the interest that you pay, you can save them or exempt them in section 80C. You have to keep in mind there is a cap from the government that is 2 lakh rupees per annum. Meaning, if you're paying more than 2 lakh rupees, the limit is only up to 2 lakh. Let's say you paid 3 lakh this year in home loans, only your first 2 lakh will be considered. The remaining 1 lakh will be taxed. House rental allowances, again, if you're making payments per uh, if you're making rent payments per month, you can use that as an HRA and get an exemption from income tax. Leave travel allowances, just like we discussed earlier. Any travel that you took within this year, it should be not more than two domestic travels. Sorry, at a period of 4 years, not 2 years, for 4 years. You can write them off as leave travel allowances. So in conclusion, these are your different tax saving schemes or tax saving investment for your income, whether it might be through salaried employee, sorry, through your salary or through your business. You can always use section 80C, 80G for different tax exemptions. Now let's move on to our next agenda, that is mutual funds. What are the different types of mutual funds are there, and how are they priced, and how can they help you? First, let's try to understand what is mutual fund. Okay, so mutual funds are investments which are made in different securities like stocks or bonds or money instruments or various different assets by different financial agencies. So usually you work with an agency for mutual fund investment, and generally they are the ones who are going to handle your finances, the amount of investment that you have decided or discussed with them. Now, mutual fund can give you both small returns as well as large returns as well, depending on what kind of risk that you're willing to take. It is open for all parties, person who has a small business or person who has a small salary or who are only able to make small investments, it's open for them as well. And person who are able to make large sums of money as an investment, they are also open to do this. So mutual funds are generally open for anyone who's willing to invest, anyone who has any sort of amount to invest. The minimum amount that you can invest in any mutual fund company or agency or bank is 500 rupees. You can start with 500 rupees with mutual funds. So generally mutual fund is considered as very affordable or very open for anyone. As I mentioned, you can start investing with just 500 rupees. Now, let's discuss how mutual fund works. For example, if we take a company like Birla Mutual Fund Agency, let's say they have started a new scheme, okay, where they're targeting to invest 1 crore rupees from 100 different investors. Okay, that will be 1 lakh rupee per investor, meaning Aditya Birla Mutual Funds will be collecting 1 lakh rupee per investor times 100 investor, they will have 1 crore rupees to invest. Now, let's say they are selling one unit for 10 rupees. One unit for 10 rupees, meaning each investor will receive 10,000 units. For example, let's say Aditya Birla wants to collect 1 crore rupee for investing, and they want to give you some shares or some stocks in return. Per share or per stock, they are selling it for 10 rupees. Okay, so if you invest 1 lakh rupee with them, they will provide you 10,000 units. 10,000 units of stock, 10,000 units of share, whatever you want to call them. Okay, they will give you 10,000 units. So totally they will distribute 10 lakh units between 100 different investor or 100 different people. Okay. Now, what Aditya Birla will do is they will collect that 1 crore rupee and they will not invest it in one company because that is very risky. If you invest all of your money in one company, and if that company shut downs, or if that company is facing losses or anything, you will lose all your money or you will lose a big portion of your money. So generally a company, they will do is they will take the money and invest between different stocks, different companies. So in this example, Aditya Birla took 1 crore from 100 different people and they distributed that amount between 25 different companies. Okay, they purchased 25 different stocks. Okay, usually this is all handled by fund managers. Okay, so now after investing in 25 different stocks, this will become your asset under management, AUM. Your AUM will be 1 crore rupees overall amount that your company or your agency like Aditya Birla has invested. Now, since it's divided between 25 different stock, meaning each stock gets 4 lakh rupees, each company gets 4 lakh rupees, so they're investing 4 lakh rupees in 25 different companies. Again, why? As I mentioned, investing all your 1 crore rupee in one company is very risky. That company can shut down, that company can face losses, or that company might get involved in some sort of scam or lose money, lose employees, lose their stock value. Anything and it can happen to a company. And if you're only investing in one company, then there is a chance that you can lose all your money or you lose huge portion of your money. Or even if you don't lose your money, even if you make profits out of that company, that profit might be very small amount. So that is why companies distribute that amount between different companies. Here in this example, they are distributing your money in 25 different companies. Okay, each each company is getting 4 lakh rupees out of that 1 crore. Okay, each company is getting 4 lakh rupees. Usually, this is all taken care by a fund manager. You don't have to do that. You don't have to research. You don't have to invest. If you're working with a good investment company, usually they will have experienced fund managers who will do their entire research before selecting those 25 companies. They will not just randomly select any company and say, I will invest in this company today. They will generally do the research. They will look into the history of the company. What was the stock value 5 years ago, 10 years ago? How is the company growing? What does the future of that company looks like? Do you uh, that fund manager will think, do you think this company will be able to generate much more profit in next 5 years, next 10 years? And based on that research, they will decide which company they are going to invest. And again, this is all taken care by fund manager, because for an individual person, it can be a very hectic thing. If you are already working at a job, or if you already have your own business that you need to handle, doing all this research, looking at the market 24/7 is going to be impossible for an individual. That is why these fund managers are there. They will all do the hard work. They will do the research, and they will decide which company they are going to distribute the money with. Now, this brings us to our next subtopic, that is net asset value, NAV. Okay, so when you start investing, your fund manager will give you a NAV value of any investment. Okay, so let's say uh, you started with 10 lakh rupees. Okay, you have invested those 10 lakh rupees with a investing company, and they have invested that money to different stocks. Combining or all together, those stocks those 25 different companies will be known as portfolio. Okay, so now what is the value of your portfolio? So initially, if you or 100 different people together have invested 1 crore in one portfolio, the NAV value or the value of that portfolio will be 1 crore rupees. And let's say if that portfolio has increased, meaning those company that you have invested all gain some sort of profit, and after increment, overall invested value will come up to 1.25 crores. Let's say there was a 25% profit with all those investment. All 100 people invested 1 crore rupees altogether. 25% profit meaning 1.25 crore rupees. Now, earlier earlier value was 1 crore rupees. So that was your NAV. That was divided between 10,000 different units. Okay. So NAV value was 12 point NAV value was 10 lakh rupees per unit. Now it's now it's 12 point sorry NAV value was 10 rupees per unit. Okay, NAV value was 10 rupees per unit. After the profit, each NAV value is now 12.5 rupees. Remember earlier they sold you 10,000 units. Each unit was 10 rupees. Now that same unit has gained a profit of 12.5 rupees. Okay. Now how is that money distributed? Okay. So your overall investment will become 1.25 lakh rupees. Why? Because you purchased 10,000 units. Okay, each unit was 10 rupees. Earlier, you paid 1 lakh rupee for all those 10,000 units. Now, the new value after the profit, after they have gained some value, the new value will be 12.5 rupees, meaning your overall investment value is now 1.25 lakh rupees. Your overall portfolio value is at 1.25 crores. So your new net asset value or NAV value is 12.5, yeah, 12 rupees 50 paisa, you can say, per unit. Okay. Now redemption. How does your fund manager make sure that everyone gets equal amount? Or let's say suddenly as soon as you gain some profit, you want to sell your stock so that you can get that profit back and your money, invested money, back as well. How does that fund manager maintains those? Okay, so usually a fund manager will follow a redemption policy. Okay, so let's say they took 1 crore from all of you. They generally will not invest all 1 crore. They will save something like 10 lakh rupees out of those 1 crore. They will invest 9 crore, sorry, 90 lakh rupees, and they will save up to 10 lakh rupees, and so that they can have some liquid cash in case someone is backing out. Out of 100 people, let's say two people said that they have a medical emergency or they have a family emergency, they need that money back, they don't want to invest anymore. The fund manager cannot sell those stocks overnight. They need some time to do the research and make the sale, and make sure the fund manager also need to make sure that they're selling at a profit. The fund manager cannot sell those stocks on loss, because it's not just one person's loss, it's going to be 100 people's loss. So generally they will save some liquid amount, and out of that liquid amount they will return the money back to those investors. Okay, that is one of the redemption policy. At the same time, let's say a person wants to redeem or withdraw after some profit, after the NAV value went from 10 rupees to 12.5 rupees. And investor says, I'm happy with the investment. I made 1 lakh rupee. I invested 1 lakh rupee. I'm getting 1 lakh 25,000 back. I'm happy with that. Again, the fund manager will usually follow the same process. They will use the cash balance or liquid amount, and they will try to give you the money back. If they don't have enough liquid cash, or the profit value is more than liquid cash or cash balance, in that scenario fund manager will consider selling some stocks from some companies and then generating cash and giving you the money back. But again, this they will do this by doing a proper research or high level research, by properly understanding the market. They will not randomly just sell the stocks. Now, there can also be a fall in NAV value as well. In case a company is facing any sort of losses, again, if the profit margin is going down, the NAV value can also go down as well. And again, the number of investors back out from a portfolio, let's say out of 100, 5 people back out, again, those units are getting sold back to the company. Then again, there will be a loss of NAV value as well, meaning per unit value will also decrease. So generally in this scenario, a fund manager or the investment company will look for new people to invest, and this time they will sell, they will take the same amount of money, but they will sell lower amount of units. So last time when the scheme started, they gave you 10,000 units for 1 lakh rupees. But this time, since they need to increase the net asset value, they will take in new investors. They will take 1 lakh rupee as well. But this time, they will only give, let's say, 80% of the units, meaning they will only give 81,083 stocks or units this time, not more than that, so that they can again balance out the amount they have lost, or liquid cash they have lost, and reinvest that in different different stocks or companies. So Sushant, you asked what is the time period. What do you mean by that? Okay. Now let's talk about different types of mutual funds. One of the most common or famous mutual fund is equity based. Equity is direct mutual funds where you're investing in different companies. Next type of mutual fund is debt fund. This is not very known to a lot of different people. Debt funds are usually invested with companies who are providing different debts or loans, and usually they give you moderate amount of returns. At the same time, those are very secure as well. Next is money market funds, investing in different currencies. Another one is index funds. Next is balance funds, income funds, and then funds of funds. And lastly, specialty funds. Let's discuss about what are all these different types of funds, so that you can understand which funds work best for you. What kind of fund will be more suitable to you. Okay, now let's start with equity funds. Equity funds are obviously one of the most famous or common ones. Generally, we call it as investing in different stocks and shares in the share market. Usually invest these for different companies, and usually these are huge infrastructure companies or consumer good companies or banking companies or very fast moving environment companies, which can generate profits on hourly, or if not on minute basis. Their value fluctuates every minute. Next is debt fund. Debt funds are usually with government or banking agencies where you can invest in loans. So your money is generally invested with different government bonds or different fixed income asset companies or different banks. They usually take your money and distribute it between different loan seekers, and generally when they pay their loan back, they will pay with interest, and generally that interest will amount to a profit. A percentage of that interest will amount for a profit for you as well. Next is money market funds, investing in different currencies or investing in different cash markets or investment companies or credit risk companies. Now, keep in mind, money market funds are considered as very high risk funds. The returns are very good. You will get a better percentage per year, but at the same time, it is also considered as a very risky process. Next is balanced or hybrid fund. In this section, generally a company will invest in two different you can generally your company will generally invest in various different kinds of companies which are very risky. Maybe it will take one or two companies which are very risky so that you can make good amount of money from them, and at the same time it will not invest all your money with that risky companies. They will take that money and some portion of your amount they will invest in moderate companies which have a medium amount of risk, and at the same time medium amount of returns as well. Keep in mind, high risk means the risk is very high, but at the same time, the profit margin will also be very high. So let's say you invested 10 lakh rupees in very high risk company. Within a year, you might be able to gain up to 20% or 30% of your investment. Meaning, if you invested 10 lakh rupees in a high risk company, at the end of the year or after maturity, you if the profit was 20%, you can get 12 lakh rupees back. High risk means high rewards, but keep in mind, because it's high risk, meaning it can go in a huge loss at the same time as well. It can go into huge loss, meaning you can go negative 20% as well, depending on the market, depending on the type of company it is, and depending on the situation the company is going through. You can go into negative 20% or negative 30% as well, meaning you invested 10 lakh rupees, and at the end of the year, if the company went into loss of 20%, you only get 8 lakh rupees back. You will also face that 2 lakh rupees loss. So keep in mind, high risk companies can give you good returns, but at the same time it can also result in losing your money. Generally, high risk companies are considered with people who are young, who are not in a financial constraint, meaning you don't have a lot of loans, you don't have a lot of responsibilities, you have a lot of money but you don't need a lot of money. Generally those kind of people are the ones who invest in high risk company because they would like to try their luck. If they invest 10 lakh rupees and next year if they can get 12 lakh rupees, it's very good for them. And if they even if they lose 2 lakh rupees and next year if they get 8 lakh rupees back, it's not a big deal for them. So generally high risk investments are generally considered by youngsters who have a lot of money, who are financially well settled, or who have financial support from their family, and who do not have a lot of expenses. Those kind of people will consider. Next comes moderate or balanced or hybrid. Hybrid is considered by a person who has some expenses, might be some little bit financially sound, but have some expensive, maybe have some debt, but at the same time they're also able to save good amount of their salary or good amount of their income. They will invest in balanced and hybrid so that they will get good amount of profits. Generally, these investments will gain you at least 6% of profit that is guaranteed, meaning you invested 10 lakh rupees. The company will invest in 10 different companies, 2 lakh rupees in a, two different high risk companies, 5 lakh rupees in moderate risk companies, and remaining 3 lakh rupees in uh, low risk company. Low risk company means you will always get your money back. There is very low risk, very low chances of losing your money, but at the same time the profit returns will be very low as well, maybe 3% or 4% or 5%. Meaning if you invested 10 lakh rupees in a low risk company, it is guaranteed that you will get your money back, almost a guarantee that you will get your money back, but the profit might just be 3 or 5%. Even if it's 5%, you will only get how much? You will only get 50,000 rupees as a profit. In a high risk company, you invested 10 lakh, you got 12 lakh, but there is a chance that you will lose the money, you will only get 8 lakh rupees. In a low risk company, you invested 10 lakhs, you got 10 lakh 50,000 back. So you got some profit, small profit, and your money was safe. In between, you have balanced and hybrid. Okay. A company will invest in different markets, different types of businesses, both high risk, medium risk, and low risk, and they will try to generate good amount of profit for you. Now, again, person who is financially sound will consider high risk company. People who are young generally consider high risk. People with some sort of financial support but who have a little bit of constraint will consider balanced or hybrid funds. People who are in huge constraint, who cannot afford to lose a single rupee at all, will generally go for low risk investments because they will save the money. They will not gain a lot of profit, but at least they will save the money. Their money will be safe. Next is index funds. Index funds is a little bit different. Okay. Usually, index funds are within the stock exchange Sensex. Okay. They will have particular companies that they have selected as, who has a mirror movement or who has a proper gain. Those are generally decided by your stock exchange agencies, maybe your national stock exchange or your Bombay stock exchange. Every year they will come up with top 10 companies or top 10 index companies to invest, and they will also look for the returns. These companies generally get you moderate amount of profit. So you can, if you're looking for a balanced or hybrid, you can always go for index funds as well. Next is income fund. You can invest in different bonds or, you know debentures for in uh, for income funds. You can invest that money, you can use those schemes, make monthly payments or fixed one time payment, and then you will get good amount of returns in this as well. Next is funds of funds. Okay, these are the funds who are investing in hundreds of different mutual funds. And again, this is also considered as very low risk investment. At the same time, this will give you uh, least amount of profit as well. But the good thing about this investment is it is handled by not just by one fund manager but multiple different fund managers. So many people, a team of people will work together, they will decide where the money should go, and they will bring your they will gain some capital on your investments. Next is specialty funds. Okay, specialty funds are usually maybe a niche sector or niche particular industry, or maybe some international stocks or global stock, or maybe in real estate or assets or gilt funds. They will invest in special kind of areas. Okay, specialty funds. Okay, so let's say you take one industry, something like medical industry. Medical industry has been booming for last 2 years because of COVID. Okay, last 2.5 years, it's been booming because of COVID. So that is one particular specialty. These fund managers will particularly invest only in medical companies or pharmaceutical companies which are trending right now, which are generating profits right now. Those are specialty fund. And again, keep in mind these specialty fund can also fluctuate as well. For example, pharmaceutical companies in last 2 years, they have gained a lot of profit mainly because of COVIDs. Maybe because they were working on vaccines, maybe they're working on different PPE or anything to provide protection to the citizens, to the doctors, to healthcare employees, etc., etc. And a lot of people were investing in research and development to fight COVID. Pharmaceutical companies, medical companies gained a lot of profit. But keep in mind, as soon as the pandemic is over or COVID goes away, the value of those companies will also come down as well. Tomorrow, immediately, let's say tomorrow, the risk of COVID gets super low. No one cares about COVID anymore. Also means no one will care about those companies anymore as well. So keep in mind, this is also a high risk investment. Now, how does mutual funds work for a retail investor? Okay, retail investor is someone who is investing in huge amounts, who do not, uh, who who has a lot of time to do the research, who do not depend on different fund managers, who do not depend on a mutual fund company or agency. Those people are known as retail investors. Now, these people can also invest themselves as well, but they need to do their own research. Okay. Mutual funds generally take your money and distribute it between different, uh, you know, uh, distribute it in between different companies. But again, an individual will have to do their own research and decide where the money should be invested. Okay. Now, these are the two different ways a person can invest in mutual funds. One is a lump sum amount, another one. So, lump sum amount is generally a wholesome amount. Let's say you have 5,000 rupees today. Again, as I said, keep in mind we can start investing as low as 500 rupees as well. So, let's say you have 5,000 rupees right now in hand and you want to invest, you can invest it in lump sum, meaning you can invest this money for a period of lock-in period of 6 months or 1 year or 3 years or 5 years. You can go ahead, give your money to the mutual fund company, select a plan, and your money will be locked for 6 months or maybe for 1 year, for 3 years, for 5 years. And after the maturity, you will get your money back with your profits. If you try to withdraw, if you try to withdraw before the maturity date, there will be a penalty. Keep in mind, for all mutual fund investment, there will be a penalty if you try to withdraw before the maturity date. So if you have decided your lock-in period is for 6 months, then it is advisable that you should wait for 6 months before withdrawing that money. Unless until it's a life-threatening emergency, try not to withdraw your money, because there is a chance that you will lose your profit, and at the same time you will lose some amount of money from your investment. So let's say you invested 5,000 rupees for a lock-in period of 6 months, and the profit margin was 10% per year, but you only invested for 6 months, meaning it's you're only going to get 5% back, meaning you will get 5,250 rupees after 6 months with your profit. If you invested in the same bond for same stock or equity for 1 year, you will get 5,500 rupees back. But keep in mind, if you withdraw, your lock-in period is for 6 months, but you withdraw within 5 months or even one day before your maturity date, after 5 months and 29 days, it is just one day away from 6 months. If you withdraw, you will still face some penalty. Okay. Instead of getting 5,250 rupees back, First of all, they will deduct at least 5% of your amount, meaning they will deduct 250 rupees. They will also charge for some service charges or service tax. That will be somewhere around 100 or 200 rupees. You will only get 4800 rupees back. So always keep in mind, try to invest, try to make sure that you don't withdraw your investment before the maturity date unless until it's a life threatening emergency. In that scenario, obviously you will have to withdraw, but if not, try to make sure you meet your maturity date to benefit for your entire profit without any penalties. If you withdraw before your maturity date, you will always face some penalty from the investment agency. The second method of investing is SIP, systematic investment plan. Okay, you can again start investing with as low as 500 rupees. Okay, generally the SIP will be set on a fixed date and it is also set on at auto debit, meaning let's say you have decided that you want to invest 500 rupees per month for next 1 year, and you have decided the date will be 16th of every month, and you have to provide your bank information as well. What will happen every month, 16th of every month, your the investment company will deduct 500 rupees from your bank balance and invest them in different markets. And again, same rules apply here as well as lump sum investments. If you withdraw before your maturity date, you will always face some penalty. And again, it is highly advisable, if you're investing, do not try to withdraw before your maturity date, even 1 day before your maturity date, because you might lose all the profit you have gained, and at the same time you might not even get 100% of the amount that you have invested. So for example, if you have invested 500 rupees per year for 500 rupees per month for an entire year, meaning you have invested 6000 rupees in that year, and let's say you got a 10% profit in that year, meaning your overall amount will come up to 6600 rupees at the end of that year. If you wait till your maturity date, you will get your entire amount, that is 6600 rupees. But even if you withdraw 1 day before your maturity date, let's say tomorrow is your maturity date, tomorrow you are supposed to get 6600 rupees, but today you withdraw the money, you will not, first of all, you will not get your profit, or they will deduct 10% or 5% of that amount, and there will be service charges, fund manager fees, all those things will also be deducted from your investment. So instead of getting 6600 rupees, you might only get 5500 rupees back after investing 6000 rupees, or 5800 rupees, 5800 rupees back. Best case scenario, you invested 6000, you got your 6000 back, but that is the best case scenario. So that is why it's always advised that do not withdraw before your maturity date unless until you don't have any other option. Also keep in mind, also keep in mind, if you miss your payment date, let's say 16th of every month is your auto debit date, and you don't have enough bank balance on 16th, your bank balance is 0 or maybe 300 instead of 500 rupees, it will attract some penalty as well. They might charge you 50 rupees, they might charge you 100 rupees, they might charge you 250 rupees, depending on the company that you're working with, depending on the agreement that you have signed with that company. So again, if you have opted in for SIP with a particular date for auto debit, make sure you have that money in your account on that date. This will help you save your own money, because all that money that you pay in penalties are not considered as investment. You are flat out losing your money, losing your hard earned money. So it's always advised that make sure you have enough money on the date of debit or a day before your debit, and make sure you do not withdraw unless until you don't have any other options. So let's discuss some more details about SIP. Okay, how does SIP work? Okay, and how is it going to benefit you. Okay, and it'll we will also discuss about how to select a mutual fund scheme, what is going to be more suitable to you, and how can you set up your SIP plan with any particular mutual fund company for their particular schemes. Okay, and what is their auto debit and how is NAV value decided on auto debit period. Okay, now first of all, let's discuss what are the different benefits of SIP. Again, one of the major benefits of SIP is, as I mentioned earlier, you can start investing as low as 500 rupee per month. Okay, you can start investing as low as 500 rupee per month. So if you don't have a lot of money to invest, but still you want to see how investing works, you can start with 500 rupees per month. Okay, usually rupee cost is averaging in SIP, meaning your money is divided between different portfolios and you will be paying in installments for your investment. You don't have to pay a huge lump sum amount. If you're planning to invest, let's say 1 lakh rupees, if you opt in for a lump sum investment, you have to pay 1 lakh rupees in advance. But if you opt in for SIP, you can divide that 1 lakh rupee in a period of time, maybe 6 months, maybe 1 year, maybe 2 years, etc. Generally, SIP is handled by professional fund managers who do their research. And generally, when you're working with investing investment company, they will also provide you the information about the fund manager. They will let you know how many years of experience this person has, what are the different portfolios this person is handling, so that you can have a better understanding of your investments. It will also help you gain some financial discipline as well. If you have a habit of spending a lot of money without saving, this can help you. At, with this scenario, you can at least save 500 rupees per month. If you're investing, even if you're investing the lowest amount possible, still you're saving 500 rupees per month. And it will also help you with the power of compounding, meaning a lot of different people's money will be combined along with your money and invested with the company. Now, these are the different types of SIPs that are there in the market. There's fixed SIP, and then you have top up SIP, you have perpetual SIP, and you have flexible SIP. Okay, fixed SIP. Fixed SIP is the fixed amount that you decide that will be deducted every month. So let's say you have decided 5,000 rupees per month instead of 500. Let's say you have decided 5,000 rupees every month. On that particular date, 5,000 rupees will be deducted from your account. Now there is also a top up SIP. Let's say you're already investing in one SIP, but you have more income or you have more money to invest. Let's say you have one more thousand every month to invest now. You can use a top up SIP so that 5,000 will go to your existing SIP and another 1,000 will be invested into a different SIP. Then you have perpetual SIP, meaning paying for itself. So in this SIP, you generally pay for one particular period of time and remaining payments will automatically start coming in, meaning usually these are long-term SIPs where you're investing for 20 years or 30 years. In this plan, you will invest for maybe 10 years or 5 years. You will make the monthly payment for 5 to 10 years. Remaining 10 to 15 years will be again made payment from your profits. So remaining period of time, you don't have to make any payments. Now, lastly, you have flexible SIP. In this scenario, you can make flexible payment based on your preference. So let's say you want to invest 5,000 rupees this month, maybe 10,000 rupees next month, maybe just 1,000 rupees after that. In that scenario, it's better if you opt in for flexible SIP plans. This will give you a lot more freedom to invest based on your financial scenario of that particular month. Now, these are the couple of things that you should keep in mind. This is our last topic before we close our session today. These are the things that you need to keep in mind before you start investing in mutual fund. Maybe it's a lump sum amount, or maybe if you're opting in for SIP. These are the things you have to keep in mind. These are the things you have to consider before investing. Okay, different mutual fund categories have different risk levels. Just like we discussed 5 minutes ago, not all investments are the same. Some investment are high risk level, meaning it's high risk. You can get a lot more profit, but at the same time you can lose all of your money, or you can lose a huge portion of your money. Okay, returns are profitable are not guaranteed in this high risk category. Then you have moderate risk, where the company is moderate amount of risky, meaning you can get good amount of returns, not high returns, but good amount of returns. And even if it's loss, there is almost a guarantee that you will get the money that you invested back. And then there is a low risk company, where there is a almost 100% guarantee that whatever amount that you have invested, you are going to get that back, along with little amount of profit that you have gained, but again the profit will be really low. Now, next thing is direct plans give you higher returns. If you're directly working with a mutual fund agency and with no middleman, no agents, no third party companies in between, that will give you bigger returns, because those middlemen will take a lot of your profit and then give you the money back. So let's say instead of directly working with a company, you're working with an agent. You pay 10 lakh to that agent. That agent will pay that agent will only pay 9.5 lakh to the company. He will keep 50,000 rupees as his profit. And after investing, let's say that 9.5 lakh became 12 lakh, that company will pay 12 lakh to the agent. Again, agent will only give you 11 lakh rupees back, and he or she will keep 1 lakh rupees as their profit margin, okay, or as their commission. So that is why it's always better if you directly work with the investment company rather than going through agents, so that you can get better returns on your investments. Also keep in mind, you won't get same returns every year. Just like I said earlier, let's say you got 10% profit. It's not a guarantee that you will get 10% profit for next 10 years. You invested in a 10-year plan. Maybe this year you will get 10%, next year maybe you will only get 7%, maybe a year after that you will get 12%, maybe a year after that you only get 9%, maybe a year after that you will get 15%. It all depends on market, how the market is fluctuating. Okay, so the returns will not exactly going to be the same every year. Okay, now you have to look into the consistency of returns. It is a hallmark of a good fund. Okay, how consistent is that company with their returns? Okay, every year, let's say a company is providing at least 6% returns or 8% returns every year consistently for last 5 years or last 10 years, meaning that is a very stable company. That is a company where you should definitely invest, so that you can also consider, or you can also have a satisfaction or relaxation that your money is safe. SIP helps create investing discipline, meaning SIP systematically investing every month in mutual funds will give you a lot more power over your money, over your income, over your savings. This will create a habit for you to save the money. Next is asset allocation and periodic rebalancing are crucial, meaning understanding where you're investing your money, understanding how much portion of your money needs to be invested where is very important, and rebalancing or balancing your investments is always important. This year, let's say you invested in 10 different companies, that is good. You understood where which 10 companies that you have to invest, but at the same time you cannot just invest and sit for next 10 years waiting for the returns. You have to keep an eye out on the market, what's happening with your investment. Maybe next year one of the companies going down, you're starting to lose money. You have to rebalance that, take that money and invest somewhere else where you can gain good amount of money. Give me 1 second. So rebalancing is always important. Now, this was our topic of various different kinds of investments. Do you guys have any questions or doubts that you would like to clarify? Nothing? All right, then. Thank you so much for your time, guys. It was really nice talking to you. And again, if you have any questions, you can always reach out to me or you can reach out to the institute and they will help you connect with me. I'll always be happy to help you guys or happy to answer your questions. Thank you so much and have a wonderful day.